Hello, Andy again. Let's talk about interest rates. There's been a lot of buzz about interest rates in the last 6 months to a year. I'm sure you've read headlines about Federal Reserve raising interest rates. And there's inflation, which is part of the reason why interest rates are getting raised. Bonds and bond funds have come down a lot in price, largest drop in 40 years, 40 plus years, largely because interest rates have risen. Mortgage rates are going higher. Yet the rates that banks pay on deposits and CDs hasn't quite gone up much, if at all, depending on the bank. So I wanted to just break down some general commentary about interest rates. I don't have a particular objective in mind with this. I just want to speak some about the basics of interest rates because there's very different rates used for different things, and it's easy for people to just simply say interest rates and not fully know what rate they're talking about and how it impacts things that may impact parts of their lives. So let's start with the Federal Reserve, which is probably the biggest headline grabber. So the Federal Reserve is the central organization that oversees the banking system in the United States, and their mandate, the reason for their existence is to try to keep inflation reasonably low and keep employment high. And they have a few tools to do that. One of which is directly manipulate sounds like a bad word, but directly changing what's called the federal funds rate. That's the rate that the Federal Reserve changes when they announce we're going to be increasing interest rates 0.25%, 0.5%, 1%, whatever it may be. It's only the federal funds rate that they actually directly are able to change. So what is that? It's otherwise known as Fed funds. Now, banks that are members of the Federal Reserve in the US, they need to hold a certain amount of quote unquote reserves, sort of a safety cushion. So if they have a certain amount of deposits and loans and whatever, they have to have a certain amount sort of on deposit with the Federal Reserve as a cushion. Those are called federal funds. I take it not back. Those are just reserve dollars. And they have to have a certain amount of reserve any given day. Every member bank of the Federal Reserve has to have a certain amount of reserves parked at the Federal Reserve every day, every night. If one bank is short on federal funds for the day, on these reserve dollars, it can borrow money from another Federal Reserve bank that has an excess of reserves at the Federal Reserve. That borrowing from the bank that has from the bank that has the excess to the bank that has the deficit in reserves, that's called federal funds. And what it is, it's a short-term loan. The bank that needs the funds will borrow it overnight for one day from the bank that has the excess reserves at the Fed. The interest rate that's charged on that overnight loan is the Fed funds rate, the federal funds rate. That's the rate that the Federal Reserve directly is able to change and quote unquote manipulate. Again, manipulate sounds like a bad word, but they set what that rate is. So that rate was, and it's a target rate. It's not one specific rate any given day. It's a target. The Fed, the lowest it got was 0 to 0.25%. Now it's currently 0.75 to 1.00%. And the Federal Reserve, has already announced they plan on raising it even more over the subsequent years or beyond. So it's true that interest rates, as we stand now, in middle of May, late May 2022, will be rising more. But specifically, that's the Fed funds rate. That's what catches all the attention. That rate does not directly impact you, let's say. Again, it's the rate that member banks of the Federal Reserve borrow money or lend money to and from each other on an overnight basis. That's the interest rate they use. Now, so that doesn't directly affect you because you're not a Federal Reserve bank. You're not borrowing reserve dollars to park at the Federal Reserve. But that obviously impacts the sort of the cost of doing business for these banks if they have to pay a certain amount of Fed funds interest on borrowing money overnight from another bank. They're going to pass that along. So indirectly, when the Federal Reserve changes these overnight Fed funds rate, it does sort of trickle, not sort of, but it does trickle through other interest rates that ultimately do or may impact you. So that's Fed funds. Again, just keep in mind, it's only one specific rate. It's the overnight rate that banks borrow and lend to and from each other for reserves at the Federal Reserve. Other rates you're probably more personally impacted by are like mortgage rates. If you were to get a new mortgage right now, 30-year mortgage is kind of the standard. It's over 5% per year is the current interest. At the peak of the pandemic, or I should say trough of the pandemic, I think it was sub 3%, below 3% for credit-worthy borrowers. So that's gone up a lot. It's gone up 2% per year more since in the last year and a half or whatever. That again, indirectly impacted by the Federal Reserve rate that the Fed changes, but not directly, because when you borrow a mortgage, you're borrowing a mortgage for 30 years typically, or 20 years, or whatever your mortgage may be, 15 years. You're not borrowing an overnight loan from another bank. That's the Fed funds rate. But again, that trickles through to other lengths of maturity of loans, such as 30-year loans, etc. So pause that thought for a second about 30-year mortgages. Another thing to keep in mind is bonds. Now, I have a separate video, you can find a link in the notes, about bonds and bond funds and yield and pricing and how all this stuff is intertwined, that I did a while ago with some pretty cool graphics and spreadsheets, and make this come to life. But the point is, bonds are IOUs, whether it's from the government or for corporate borrowers. It could be a 1, a 2-year, a 5-year, a 10-year, a 30-year sort of IOU that has these ongoing interest payments and a terminal repayment of the face value of the principal value. The price of bonds is impacted by interest rates. All else equal, as interest rates rise, bond prices fall, and vice versa. As interest rates fall, bond prices rise. But what interest rates? That's the important thing to know. Again, it's not directly the Fed funds rate. The interest rates that impact the price of bonds and bond funds is largely the current yields, or the current expected or required amounts of annual interest. Let's call it or return. That's a better word for U.S. government securities. So bonds issued by United States Treasury, whether it's a 1-year bond, a 2-year bond, a 5-year bond, a 10-year bond, a 30-year bond. So I'm going to pull up something called the yield curve, and here we have it. The yield curve shows what's called yield to maturity of different United States Treasury issued bonds of varying lengths, varying maturities. Starts on you look at the bottom, the x-axis, all the way to the left, starts with 0, meaning the bond matures in effect ASAP, and followed along to the right, all the way up to bonds of 30-year maturities. Now, one of the more common bonds used as a benchmark for a lot of things is the 10-year bond. So let's look at that 10-year point. You can see the dark colored line is the most recent yield on the 10-year bond. This is as of May 21st, 2022. It is sub 3%. It's like, I don't know, I think it was like 2.8-ish, maybe slightly less as of the other day. And the dotted line above that is where the yields were 1 month ago. So 1 month ago, it was bumping just under 3% per year. And the dotted line below that is where yields were 6 months ago. And you can see the 10-year U.S. Treasury bond 6 months ago was about, let's just call it 1.5% annual yield. So it's the changes in these rates, these yields, that directly impact the prices of bonds. So your question now should maybe be, or hopefully be, well, what changes these yields? Is it the Fed funds rate that we read so much about? No, not directly. Now, there's lots of different theories about what changes, what impacts these different yields on the various maturities of Treasury bonds. Some of them are simply, the yield of a 10-year bond is nothing more than the expectations of what short-term interest rates will be in 10 years. Some are this, I think it's called market segmentation theory, where borrowers that need 10-year money dictate what their rate is for whatever the reasons are. Borrowers that need 30-year money dictate what the rate is for whatever their reasons are. Borrowers of short-term stuff dictate those rates, etc. But the takeaway here is that the yields and the changes in yields on this yield curve for these various maturities of bonds is set by the market. It's basically supply and demand and market expectations. Now, to some extent, sure, the Fed funds rate, you can make a good argument, trickles through and impacts the level of rates on these things, but it's really just institutional investors set what these are. So, for example, when the United States Treasury announces it's going to be issuing new 10-year bonds, they do an auction. They poll the big brokerage houses and investment banks and say, hey, what rate do you think buyers want or require to buy these bonds? And the market sets what that rate is. And the market sets it based on their views of inflation over 10 years, their views of where short-term rates will be in 10 years, the amount of supply and demand for 10-year bonds. All else equal, the more there is demand for 10-year bonds, the lower the required yield, the required return is going to be, and vice versa. So where I'm going with this is, many of you that have bonds and bond funds will have noticed your bond funds dropped a lot so far this year. And you, again, read the headlines, biggest drop in 40 years. That's not because the Fed funds rate has gone up or is anticipated to go up necessarily. It's simply because look at the change in yield again. Let me pull that graph back up. Look at the change in yield of 10-year bonds. And it's a 10-year bond. If you have a broad, diversified, quote unquote, total bond market fund, mutual fund or exchange traded fund or whatever, the price of that bond fund is most impacted by change in 10-year treasury yields. And look what happened over the last 6 months. 10-year treasury yield went from about 1.5% to let's call it 3%. So roughly 1.5% increase. So what does that do? Now, if you look at the video, go back and take a look at the video I linked below about bond and bond prices, and there's something called duration, which short and skinny of it is a duration is a measure of how much a bond's price is anticipated to move for a given change in interest rates. And a 10-year bond, the duration is such that if there's a 1.5% change in 10-year interest rates, you would expect that bond or a fund of bonds like that to go down about 10% in price. Lo and behold, that's what happened. Not a surprise. The bond funds, like the total bond market funds, that have a little bit of everything, but largely average around a sort of 10-ish year type of bond risk or bond exposure, has gone down 8, 9, 10% year to date because the 10-year yields have gone up about 1.5%. So let me pause there. Bond and bond math is really sort of tricky and hard to grasp if you're not familiar with it. But point is, the change in bond prices is largely driven by changes in interest rates, not the Fed funds rate, but the market derived, the market implied required yield to maturity or required return on bonds of different maturities as plotted out in the yield curve. So does this mean that the Fed announced they will be increasing rates more going forward? Does that mean bonds and bond funds will be coming down more in price as interest rates rise? No, not necessarily. Because again, remember, the Fed only changes or is able to directly control the very short-term Fed funds rate. They do not directly control the yield to maturity, the required return of 2-year, 5-year, 10-year, 30-year Treasury bonds. Those are driven by market participants. So in theory, what could happen is even if the Fed does continue to raise up the Fed funds rate, the market, institutional investors, can be concerned, can say, okay, we don't think inflation is going to be as high anymore going forward, or we think the Fed's going to reverse course with the interest rate changes. So the market can now start to drive down the required yields to maturity on 10-year bonds. So even though Fed funds rate may be going up, the 10-year bond rate may be coming down. And if it does, bond prices, a lot of bonds and bond funds may go up in price from where they are now. So it's this interesting dynamic, interesting relationship. But the point is, just simply saying interest rates are going up or interest rates are going down doesn't really mean anything. You have to know about what interest rate specifically you're referring to. Is it Fed funds? Is it bond yields? Is it 30-year mortgages? Just coming back to 30-year mortgages, the market-based interest rate that most impacts the rate you have to pay on a 30-year mortgage is the 10-year U.S. Treasury bond, believe it or not. I'll leave it there for now. There's a few reasons why, but all else equal, the higher the yield is on the 10-year Treasury bond, the higher your 30-year mortgage will be, and vice versa. So no surprise, we saw the 10-year Treasury yield went up from about 1.5% to about 3% now over the last 6 months, which is not coincidentally when 30-year mortgage rates have really spiked up from whatever they were, 3-ish% to now a little over 5%. And final comment about interest rates is banks. A lot of people ask, well, with interest rates going up so much, why haven't I seen the interest rate on my checking account, savings account, or CDs go up a lot? They've gone up some, but why haven't they gone up a lot? There's sort of two main functions that drive the interest rate that banks pay on their deposits, be it checking accounts, savings accounts, CDs, certificates of deposit. One is, yes, the market level of interest rates. All else equal, a higher Fed funds rate, you would think, should lead to higher interest paid on bank demand products. But it's also a function of the bank's own supply and demand. If banks don't want or don't need extra deposits coming in, they're not incentivized to have to pay more interest because they don't want it. Banks are already pretty flush with cash, or they were. They may be changing now as the economy sort of weakens. But rewind a year, banks were flush with cash. They were flush with people having deposits, savings accounts, CDs, whatever, money markets. I guess not money markets, but typical demand deposits. So banks didn't have a need for more cash, so they're not incentivized to pay higher interest because they want to turn off more cash coming in. That's why they kept rates so low. So now, who knows when exactly we'll see bank rates start to change more if and when banks start to have more demand, more need for deposits, sure, then they'll have to start raising interest rates to attract more depositors. But until that happens, expect bank product rates to continue to stay low. All right, I dropped a lot on you. I just sort of wanted to sit down and spit my thoughts about interest rates and the markets, and specifically bonds and bond markets, and a little bit about mortgages. Hope you found this helpful. Again, definitely check out the link to the video I did about bond and bond prices. Super nerdy. It kind of can't be nerdy when you're talking about trying to value bonds, but I tried to make it as straightforward as possible with some, hopefully you'll find clean examples. For those of you that want to learn more about bonds and bond prices and yields and etc., definitely check out that video. I think you'll find it super informative. That's that. Take care. See you next time.